taking the time out of your day to attend. For those of you that are not familiar with myself, my name is Ian Ball. I like to associate myself with the company very closely, clearly. I joined in 2014, and as Rob mentioned in the previous presentation, I had worked for him at McEwen Mining and then subsequently Goldcorp starting in 2004. Just before we get into the presentation, I think it's very important to talk about the type of investor that we are looking to attract, and that is somebody who wants to be seen as a partner in the business, wants to be treated as a partner, and has a longer-term orientation. When we started out building the company in 2014, the idea was to look at other firms that have treated their shareholders well and have generated capital gains. So I took a lot from Berkshire Hathaway outside of the mining sector. I looked at Franco-Nevada and Goldcorp, as well as American Barrick back in the 80s, and said, well, what were they doing right, and how can we apply that to our business? And as you can see here, when we started off, we were trading at 35 cents a share, and then today we're trading at $14 a share. And obviously a lot of this has been driven by exploration success, but there's also been a discipline in terms of how we manage our capital structure, how we go about allocating capital, and this has played into, I think, treating our shareholders quite well, which has delivered the result that you see here today. So if you have a shorter term orientation, I would advise not looking at Abitibi because we trade around $100,000 worth of shares a day. That's about 7,000 shares. So it's not a good trading vehicle if that's what you're looking for. I do apologize that these numbers are in Canadian dollars, and the reason why they haven't been converted to US is because our financials are in Canadian. So we want to have it consistent that if you look at the presentation, you go back to our financial statements, they were all the same. But a quick summary. Our market capitalization is just under $180 million. We have cash and securities of just below $50 million, and I will be talking to you about how we go about allocating capital on behalf of our shareholders. We are debt-free. We have 28 royalties within the portfolio, but the one I'm going to be talking to you mainly today is at the Canadian Malartic mine. This is the largest gold mine in Canada. It's the 10th largest gold mine in the world. So it's a significant asset that's going through the next phase of growth. We do generate free cash. We have a very small float. We have 12.5 million shares outstanding. So when I talk about looking at companies like Berkshire Hathaway and not issuing shares, we certainly take that to heart. We are buying back shares, and we just paid our first quarterly dividend yesterday. It's 3 cents a share quarterly, 12 cents annually. This picture was taken almost 1 year ago today. We listed on the NASDAQ International Exchange, and we closed the exchange 1 year ago. You can see where our royalties are located. All of them except for one are located in either Quebec, Canada, or Ontario. There's one in Turkey. And there's an old saying in mining that you should only invest where they wear winter jackets. And that's probably that's something we feel very comfortable with, and that's why we're located mainly in Canada. But it also comes down to where do you have your skill set. And I don't think we possess the skills to be assessing royalties all over the world. We feel we have an advantage, particularly what they call the Abitibi Greenstone Belt. And we want to stay where we feel comfortable because we have some degree of knowledge of what the geological setting is like and how much gold can be discovered there. And we also have a very good sense of values and networking opportunities. You can see our share price 2014 to present. The shares are up 4,000%. And you can see year to date, we're up 57% against some of our royalty peers. The one caution I would point out is we are the smallest royalty company being shown on this slide. So it's much easier to grow your share price when you're small. The bigger your market cap, the larger the anchor you typically forge. So just a degree of caution there. And then you can see how our shares have performed against some of these smaller to mid-cap gold producers. There is a theory that in a rising gold price environment, a gold producer will outperform a royalty company because they have greater margin expansion. But as you can see, we've performed quite well even in a rising gold price. And a lot of this is coming because of the organic growth within the royalty portfolio. As much as a higher gold price is great for our business, It's the organic growth that's the real driver for the performance. As I mentioned, we started paying a dividend. You can see how we stack against some of our royalty peers. We are on the lower end in terms of yield. The one thing I would say is that we're very early in our cash flow generation, and we do expect as our cash flow continues to increase, we should be able to increase our dividend along with it. And then how we stack up against some of our peers on the producing side, not many gold producers pay a royalty, so we stack up quite well. So it's another way of playing the gold price environment. So before we go into the royalties, I want to talk about the share structure and how we go about allocating capital. As I mentioned, we have a very small share count at 12.5 million shares. We just authorized our buyback for another year, and we've purchased just under 250,000 shares. Why would we buy back shares? Well, one, we know the asset very well because we already own it. There's no skeletons in the closet that you have to worry about. And as long as you can buy back shares at an attractive valuation, we think that's good for our shareholders. And we look at it from a net present value of future cash flows. And if we can buy it below the current value of that, usually about 0.75 to the discounted cash, as we think is an attractive opportunity to be accretive for our shareholders. So we plan to keep buying back our shares. We also have the fewest number of shares outstanding of any mining company in the world that has a market cap in excess of $100 million. So again, this is where we're getting this from the Berkshire Hathaway, because both in mining and other industries, when you issue equity, you typically cost your shareholders money. And I always find it interesting that people will issue shares to grow, but when you issue shares, you're actually giving up a part of your company to a group of strangers. So if you issue 20% of your stock, you just gave up 20% of your current assets. So we'd rather grow through cash flow and the cash on the balance sheet. In terms of our cash flow, it's still relatively small. We started in 2017 generating just over $2 million. This year we expect to be $4 to $4.5 million, but we do expect that as the royalty continues to expand, and I'll be getting into that, that there is a potential to materially grow these cash flows from the current status. And you can see right now, this is the Canadian Malartic mine. This is a drone image. You can see the open pit in the background. And we're currently getting royalty income from what they call the Barnett extension and the Jeffrey zone. And then you can see it on another satellite image as well. The Jeffrey zone right here, our royalties in the dashed aqua blue line, and the main open pit at Malartic. So the majority of the cash flow is coming from these two areas today. In terms of our balance sheet, we just have under $50 million. And so the question I often get from investors is, well, how are you going to allocate that capital? And so I look at it in tranches. I'm willing to buy royalties on very early stage projects where we put in very small sums of money, $5,000, $10,000, $15,000. But these properties need to be near an existing mine, and they have to have signs of gold mineralization on it. So there's at least a chance there'll be a discovery that can then be fed through existing infrastructure. I view these as lottery tickets. We've bought 18 of them so far. We launched a competition online where we asked people to submit their properties to us. We spent $200,000 to acquire these 18 royalties, and we are now seeing exploration being performed on about 5 of them. The second tranche is looking to invest in royalties around the Canadian Malartic mine. There's a paradigm shift going on there that's created the value for our main royalty, and we think that within that region we can allocate capital successfully. And the third is looking for another paying royalty that would be within North America, where we have some insight in terms of the exploration potential, and that we have not been able to execute on thus far. We've been quite patient. We started with $35 million in 2015. We've grown it to $48 million. So we're not in a rush to spend this money. We are very patient trying to find the right opportunities. We are debt-free. You can see our share capital here in terms of how the ownership is broken out. Rob, who's with us today, he owns 11% of the company. Although when I started in 2014, I didn't have the financial means to buy 25% of Abitibi, although I wish I had. I did go out and say, I would take all of my after-tax salary and all my after-tax bonus, should I be awarded one, and I would invest it back into the market each and every week. And so I've been doing that now for 5.5 years. I get no salary to live a lifestyle. And now that we declared dividends, I said I would take all my dividends and reinvest that back into the company. So this is the exciting part, and I think this is really the driver. So I'm not buying back stock because optically it looks good. I'm here to make money. That is the sole purpose of this. And I think the opportunity we have at Abitibi is very unique. The royalty that we have is at the Canadian Malartic mine. Before I talk to you about that, it's important to understand the history. Canada has many mining regions. You have Red Lake, you have Timmins, you have Kirkland Lake, and the Malartic camp was almost the orphan of the group. It operated originally from 1935 to 1983. From 4 underground mines, it produced just over 5 million ounces of gold. The properties actually proceeded to go into bankruptcy. A company called Osisko Mining bought it out of bankruptcy, and they had a geological theory that they could find a lot more gold near surface that would be lower grade. And they did. They found another 11 million ounces of gold and turned it into Canada's largest gold mine. They were purchased in 2014 for $4 billion by Agnico Eagle Gold and Yamana Gold. So the next evolution is, do these deposits continue deeper below the current pit? And what we're seeing is that they do. The operators have outlined another 8.4 million ounces of gold below the existing pit. There's another 500,000 ounces that's not shown on this slide where we have a royalty. And in early 2020, we're going to find out how much of the 8.4 million ounces sits within our royalty ground. For every ounce of gold they produce, we approximately get $50 an ounce based on today's gold price. What's interesting is that some of the best drill results are now coming out at the bottom of this mine. And so there's good potential to continue to expand these deposits deeper. And let's go through. And then you can see here's the main deposit in red. And although you can't see it on the slide, they're currently moving what they call the Trans-Canada Highway. And it's $135 million to move the highway. So they haven't been able to drill up here for safety. They didn't want people drilling for gold while they're moving the highway, which is understandable. But that highway is going to be completed this month. And these were drilled back in 2008, these drill holes. So not only is there potential to continue to expand this at depth, there's the potential to expand it to the northwest. This is already one of the biggest discoveries in Canada today. And I think it's going to get materially larger from this point on. I just want to go back 2 slides. In terms of going back to how you allocate capital, and I said we like to spend money around the Canadian Malartic mine. So in 2016, this was our royalty package. This was the mine. We then found out Canadian Malartic, who's the operator, bought this land to the east. So we found out who owned the royalty, and for $750,000, we were able to drastically expand our royalty package. And that's one of the advantages by sticking to areas that you know. You know who owns the royalty, you can move quickly, and you have a very good sense of value. This is the Canadian Malartic Mill. So it's the second, what we believe is the second largest gold mill in the world. It operates at 58,000 tons per day. And the reason why I like this is because it gives you a bit of a free option that if the ore from the underground is more profitable than the open pit, all they have to do is slow down mining on the area where we don't have a royalty, and then they could possibly increase the production from the underground without having to expand the mine. So with a mill of this size, it gives you a lot of flexibility in terms of how you're going to go about treating these new discoveries. So it's really a state-of-the-art facility. It was built back in 2010. In terms of looking at our share price, you say, well, it's already had this run from 35 cents to $14. The way that I look at this is we have to look at our net asset value per share, or it's your discounted cash flow per share. And I think this is going to continue to increase because new discoveries are being made at the property. Those ounces will get turned into cash flow. You're seeing right now us buying back shares at a discount to our net asset value, so that's obviously accretive. And then how do you allocate the capital on your balance sheet to increase your net asset value? And then you look at the valuations of our peers, And I think right now we're trading around 0.75 to our net asset value. And the reason why we'd be trading below our peer group is that the project has to get de-risked. As the project moves forward, right now they've defined these ore bodies. There is a permit that was approved late last year to move these towards production. We're expecting a formal production decision at the end of this year, and that would be followed by about a year and a half of underground construction, and that would be fed to the mill. So as these milestones get met, we think the valuation will improve, as well as the net asset value will continue to improve as well. Just going back to allocating capital, because I think it's a very important point that unfortunately the mining industry hasn't been great at. Here's our royalty package again within the broader Abitibi Greenstone Belt. This was the beginning of 2016, and for $2 million, we were able to drastically increase our royalty holdings. And I won't go through each one of these properties, but there was a strategic rationale why they were acquired. And again, talking about low-cost lottery tickets, this is Ray Lake, Ontario, where Goldcorp got its start, and we were able to fund a prospector with $10,000 to acquire a royalty wherever you see a dashed blue line. That prospector sold the ground to another junior mining company, and they're now starting a 10,000 meter or 30,000 foot drill program. So these are lottery tickets that, they could have value, but we like buying these because they're so inexpensive. And so the other one that I really do like, although maybe the jurisdiction isn't our preferred place to invest, is in Turkey. And here in yellow, we bought a 3% royalty. So that's getting 3% of all the revenue that would be produced for $60,000. The mine operator was mining in feet, 600 feet away, and they were drilling right on the property boundary. So what I was betting on is that at some point, the mining company will end up buying the ground of the junior, and this will be put into the mine plan. So for $60,000, I thought it was a very low risk investment opportunity for us. So that's our story. It's pretty straightforward. We have the strong balance sheet, small share count. We don't issue equity to management, so everybody here has to pay for their ownership. They don't get it for free. And we have a very good discovery at Canada's largest gold mine that's driving the underlying value. So with that, I think we'd like to open it up to possible questions, either for Rob or for myself.